So I'll go ahead and start with a little bit of marketing piece, and this is a little lighthearted. And by the way, guys, this is an informal thing. If you have questions, just raise your hand. I'll point to you, shout out to you. Be happy to go through it. You know, one of the things that we think of at the beginning of every year, we have a big goal setting thing, right? When you think about where are your marketing dollars and time being spent on, right? That's what we reevaluate every day. Every year we put our budgets together. We kind of retool everything. We had a sales rally here for all my loan officers about a week or so ago, and there's a video that I watched from a TED Talk, and this guy talked about upgrading your software. Anybody ever been on your computer and the button pops up and says, would you like to upgrade your software right now, right? And you push the button because you don't want viruses and you want the latest software. Well, this guy said, hey, you've got to actually talk about that for your own brain, right? Wouldn't it be nice if you could upgrade the software in your brain every time you got that message, right? But that's kind of what we do when we go to these and we're learning and doing things a little bit different, a little bit better, right? We're upgrading our software. So where's your next client going to come from? We're going to talk a little bit about that, some generational stuff and home ownership rates a little bit further in, and how you identify them and reach them too, right? You got to empathize with them, you got to understand them, you got to be able to know who you're after to be able to target those markets. So speaking of marketing, it's all very important, right? Especially nowadays with social media and everything. With a lot of loan officers out there, a lot of real estate agents out there, you got to set yourself apart a little bit. Who's lived in Austin for at least 15, 20 years? Do y'all remember South Congress, what it used to look like? It wasn't a good place to live, was it? A good place to even walk down. Then they rebranded it, right? They made it they called it SoCo. So now it's cool, right? So that helped out. So maybe rebranding yourself. They reset they upgraded the software for South Congress, right? It made it SoCo. So it wasn't South Congress anymore where all the streetwalkers were, right? Now it's a really cool place to be. Then, of course, South Lamar got the idea, so they started calling themselves SoLa. And, you know, we don't know how much that's caught on, but there are signs down there that showed it. And look at what's going on with South Lamar. I grew up in that area back behind South Lamar, and it is absolutely nuts what's happening on that street with the vertical mixed use and all the new apartments and condos and new businesses that are going in. Not to be outdone, North Lamar now starts calling itself NOLA. I'm not really sure if that's true, but I just made that up. So, you know, you got Crestview Station and some of these other places up there that are real nice, you know, with the metro area. We're going to get a little funny now, too. And Kevin and I talk about this on the radio show. North Burnett Gateway is now Nobu. And I don't think there's any Ewoks or anything running around out there, but you might want to keep an eye out for them. But I think that we should make this probably stick. Then there's Southeast South Austin, which is Seesaw, right? I don't know if that's going to catch on either, but I think it's kind of funny. And then my favorite one of all is also obviously East Austin, which is EAW, with a lot of renovations going on and everything. I guess my point here was that for South Congress, some of these other states, they've rebranded themselves, remarketed themselves, reinvented themselves, they updated their software. And sometimes that's what we need to do. And we need to do it not just on a yearly basis, but every single day as we're learning and advancing our stuff in our careers, right? All right, now the funny stuff's over. Let's talk about the other stuff. Let's talk about the mortgages and regulations that we're dealing with. Saw a funny quote the other day. How do you make $1 million in the mortgage business? And I know there's some mortgage guys here. You start with $2 million, right? And that's really come to the forefront nowadays with all the different regulations that are out there. I gave everybody a handout. That's the new 1003. I don't know if you know this, but the 1003 is the loan application that a borrower fills out on a mortgage loan, right? This form is mandatory on all loans. This new form is a little bit longer, has a little bit more information about it, and that's an example. Starting in July, we're going to be able to start implementing this, right, with our borrowers. And then come February 2020, and I know that sounds like a really, really far time away. It's 12 months from now, right? 2020 is 12 months from now, which blows my mind. But this is a loan application that you're going to start to see the borrowers have to fill out. And if you look through it, there's a lot more information in there to glean from the borrower, right? You've got to be a little bit more detailed dealing with the borrower. The problem we see with the regulations is implementing this. So think about all the different mortgage lenders out there, all the different websites, all the different programs that we use to process, underwrite, originate loans. Everybody has to change over to this form. It's not an easy thing. So you're going to see the industry scrambling over the next 12 months to make sure that they're completely ready for it come February 2020. A lot of people are probably going to be implementing it after July of 2019. I think we're going to start to see a few more dynamic loan application engines where they go in and it doesn't look like this. It basically just walks them down a path where they put their name in, ask if they're married, and if they say married, it'll take them to that screen and walk them through the whole thing. That's one of the things our company's working on right now. But the implementation, I think, is going to be the big deal. You're going to see a lot of companies having to update their software, update everything they do, just to be ready for this new regulation. And it's one of many we've had over the last 8 years. And like I said, it's mandatory in February 2020. So keep that copy with yourself. That way you know what's coming. And I can tell you, if a lot of people don't know in their real estate business that this is actually happening. So it might be something to talk about in the next couple of months. If you have a client that's looking to buy a house, say, hey, be prepared. There's this new application. Ask your loan officer about it. It may make you look a little bit smarter than the next person, right? Having that information. Let's talk a little bit about market share when it comes to the mortgages. So in 2016, the amount of mortgages financed in the United States hit $2 trillion. $2 trillion. That was in 2016. That was a great year for everybody, right? $2 trillion. Money to go around. It was great. Since then, we dropped 20% in the number of mortgages financed in the United States. Some are calling it a mortgage recession that we're in, that mortgage people are having to deal with, right? So not only are there more mortgage companies out there, more loan officers vying for that piece of the pie, the actual number of originations has actually dropped by 20%. So think about that. What would happen in the Austin MLS if the number of closings dropped by 20%? But there was more real estate agents, right? That would hurt your business a little bit, right? And this is what we've been suffering through to a certain extent, this drop. So that's why it's always important to keep that market share growth going, right? Do things like we're doing today to try to bring you guys in here to hopefully get your business in the future. The Fannie Mae is saying that they don't see it getting much better over the next couple of years either. The good news is for real estate agents out there is that the amount of purchase money has actually increased over the last couple of years. So this is actually good news for you. Bad news for the loan officers, good news for you. 2 years ago, 51% of the mortgages originated were purchased. Now 72% last year. And it should go to 75 or 76%. So as we see the number of houses and units being sold go up, that purchase money is going up. So that's good for you. The one thing we are seeing, though, is a lot of you see the pink there? That's refinance business that closed. A lot of lenders that were just doing refinances over the past 5 or 6 years are now getting into the purchase money space. I'll tell you that a lot of them have no idea how to purchase works and all the nuances of a purchase, right? If you think about it, we had a file that we took from an online lender not too long ago because they dropped the ball. It was on a builder deal, and they had ordered the appraisal 3 months ahead of time. And lo and behold, guess what happened? The appraisal came in short, right? Because they didn't allow for all the new comps to close and to set that new price, which the builders all do, because they didn't know that simple little nuance. And we see this all the time. So be careful if you're dealing with some of these online lenders. They may come from a refinance background where there's no sense of urgency, right? And they may not know some of the nuances that comes to closing purchase money loans. Now, they do them cheap, but they just don't do them well, right? I got an interesting stat here. This is nationwide. It feels like this is in Austin, but the number of LOs out there is about 354,900 as of, it's about 325,000 right now. And then it's for agents, it's about $475,000 and nationwide. Like I said, it feels like this, that there's that many people out there right now doing real estate. Y'all remember back in the 2007, 2008? I remember going to a restaurant and we were talking about the mortgage business and real estate, and the waiter would go, hey, I'm in the real estate business too, or I'm a loan officer too. The flight attendant on your airline would also, everybody seemed to be doing it. It seems like everybody tends to be getting back into that business right now also. But it's interesting, I don't see it slacking off, more people getting into our space, the real estate industry space. So like I said, it's important to get that market share going. Let's talk about some new products that are available. Well, there are old products that have become re-available out there. Everybody remember stated income loans back in 2005, 2006, 7? We were doing fourplexes with zero down, stated income, stated asset with like a 580 credit score. That's not back, by the way. However, we do have some outlets now where you can use stated income, right? You can actually use a stated income loan. The rates are not cheap at all, though, right? They're a lot higher than a regular Fannie Mae loan because they're not considered non-QM, which is a qualified mortgage. And how do banks mitigate risk? They charge a higher rate, right? Bank statements programs back too. We have an outlet for that. Some non-QM lenders are actually offering loans for people just out of a bankruptcy or foreclosure. Now, I'm not sure why somebody would buy a house a day out of foreclosure, right? But there might be some availability for that. We're also seeing Fannie, not really Freddie anymore, unless you've been in business for 5 years, but Fannie Mae is starting to offer 1 year's tax returns. So here's a nugget y'all can take today. Has anybody here talked to a client over the last 12 to 13 months who started a new business but wanted to buy a house? And they were told probably you got to wait 2 years, right? They may qualify for 1 year's tax return. Guess what timing we're in right now? Everybody's starting to do their tax returns now, right? So reach out on social media and talk and let people know, listen, you may qualify for 1 year's tax return even if you just started your business a year ago, right? And I guarantee you there are people out there. So put the word out and let's get some more of those buyers in on those. I know a lot of people out there that are falling into that boat.
Is that just for self-employed people, or is that like commission employees?
It could be for commission employees too. And I will tell you that when it comes to a commission employee, I know a lot of banks say you have to have 2 years commission to be able to qualify. Fannie actually says you can have less than 24 months but greater than 12 months and still qualify, and we do those all the time. So the bottom line for Fannie and Freddie is you have to have at least 12 months commission or bonus income, and we can usually work it if it's less than 24 months, unless there's something weird with it, right? Also, we're getting a lot more property inspection waivers. This is a good thing. Y'all probably heard me talk about this before, right? Y'all are psychiatrists, right? Y'all have to deal with the buyer right up front when they're looking for a house. When they get something under contract, they have buyer's remorse or seller's remorse if they're listing the house. Then you have to go through the inspection process, right? How many times have you got a call from your client that says, I just got the inspection report, I'm not buying this house, this thing was 36 pages long, and you have to walk them through, right, no, it's all normal, don't worry about it, the inspection came in good. Then the next piece is the appraisal, right? How many here have gotten an email from their loan officer saying, the appraisal's in, see attached, and you're afraid to hit the button to see what the amount came in? So we're giving property inspection waivers, especially in established neighborhoods right now, as long as our Fannie Mae and Freddie Mac allow it, and you don't have to have an appraisal done on the property, right? So this is actually really good news. And the reason that they're doing this is they have this huge database. For the last 5 or 6 years, Fannie's been and Freddie's been collecting every conventional appraisal that's been done has been uploaded into their system. So they have this huge data set that they're using to determine what the value of the property is. And if you think about it, some of these properties that they have, let's say Circle C or Billwood or somewhere over here, they may have rented those properties 2 or 3 times in the last 6 years, right? They could have been bought or sold. So they have the historical data on it. Not only do they have the purchase price, but some of the data set includes the number of bedrooms, what condition it's in, all kinds of things. So we're really happy about that, especially since there's not that many appraisers out there anymore, right? Unfortunately, there's not as many coming in as there are going out, and we see a shortage all the time of good qualified appraisers out there. So hopefully this will take some of the pressure off the ones that are out there as we get into the buying season right now. Also, I want to cover a little bit about some other products that are out there, especially for future homeowners, which we're going to talk about here in just a few minutes. USDA loans. We're still doing USDA loans, but remember there's a government shutdown right now. Anybody have a USDA loan they're working with right now? I know we have a couple of them, and they've shut their offices down, so they're not doing commitments right now. But if you do have one working, they should be, hopefully the government shutdown will be over soon, right? And we can start doing those again. Texas bond programs are fantastic. One of my favorites is the TSHAC program, Texas State Affordable Housing Corporation. It's actually a grant from the state of Texas for your down payment. It could be $5,000, $10,000, $15,000. You never have to pay this money back. There's no recapture tax on it, and there's no time limit on how long you have to live in the property. So if you think about that, if you have a first-time home buyer that doesn't have the funds to close right now, and they qualify income-wise for this grant program from the state of Texas, they could actually go in and buy a single-family house. Heck, they could even buy, under this program, a duplex and get the down payment for the duplex on an FHA loan, which is only 3.5%, and use the other income to help qualify for it and get it in zero down for a future investment property after they've lived in the property for X number of years. Yes, ma'am.
Are the numbers out, or is it like the fair house, like the other kind of type of loans where you have to make a certain amount, but it doesn't come out to the beginning of the year?
No, Nate, are those numbers out yet? for the income? I thought they did. I thought they come out in December. Didn't they? They think they're right now. Yeah. We'll let everybody know when they do come out. They go up every year, and the median household income here in Central Texas has definitely gone up. So we've seen some of those numbers increase, right? But it's a great program, if you're a first-time home buyer. And a lot of these younger buyers out there right now, they don't have a big down payment, right? But they are looking for a way to diversify. And I think buying a duplex or a single family is a great way to do that. Obviously, FHA is still offering 3.5% down. New conforming loan limits here in the state of here in Austin are $484,350. That's great news. When I first got in the business years ago, the conforming loan limits were like $210,000. Our average loan amount in our office, I remember, was like $110,000. We had to do a lot of transactions at one time. FHA's also increased theirs. And a reminder, when you're looking at FHA or conventional, depending on the number of units, the maximum loan amount actually goes up. So we were just talking about that grant program from the state of Texas for the T-Shack where they could buy a two-family. Their maximum loan amount on that, it's actually $499,000. So that's actually, are there still duplexes out there for $500,000? You know, what we've seen is a lot of people who want to live in a certain school district, they can't afford it. So what they do is they'll find a duplex in that area to buy, right? And they'll use the rents from the other side to help supplement their income and for qualifying purposes. That way their kids can go to the school that they want them to go to. And like I said, depending on their income, they may qualify up to that $499,000. Now that would be a lot, but remember, they don't have to have a lot of income if they're using the rents from the other side to help qualify for it. Couple of different things. This is conventional and this is FHA right here. When you're using one and two family, you can use all the income from the other unit to help subsidize any of the debts and payment that they have on that property. Anytime you hit 3 units to 4 units on either one of these, you can only offset the payment. You can't use the additional income to help qualify against their additional debt that they may have. No, that may not make sense, but just remember, if we go into 3 or 4 family, it's a little bit more complicated. Let's say that there's $6,000 in income on the property, but the mortgage payment's only $4,000. They can only use $4,000 of the rents to offset that payment. They can't use the additional $2,000 as income. Make more sense? Okay. But this is why you need to understand purchase money loans, right? Because the guys who do all the purchase money loans over the last year, they're the ones with the experience with this on how they get these things done. Anyway, anytime we can get away from that jumbo price range, obviously jumbo rates are a little bit better than conforming rates, but it's still a lot harder to qualify for a jumbo loan than it is for a conforming loan. All right, the big news. This is probably why you're all here. What are mortgage rates going to do? Anybody know?
Up or down?
They're going to go up or down at some point. At some point, they're going to go up or down. The good news is they've actually been dropping a little bit recently. This week they've actually climbed a little bit, but over the last 30 days, we've actually seen rates decline from in the 5s into the 4s, which is really good news for the majority of borrowers out there. So what drives rates? Fear of inflation. Really, that's the bottom line. If there's inflationary news out there, that drives interest rates up, right? Anybody remember when rates were 3.5%? Anybody selling houses at 3.5%, 3.25%? Who wants that to be back? No, you don't. Because if we have 3.25% rates again, guess what? You're not going to be selling houses because nobody's going to be buying a house because there's going to be something wrong with the economy, right? That's why we don't want 3.25% back or 3.5% back. You know, it's okay to have a little bit higher interest rates, just not too high. So one of the things you want to watch for, if you hear any inflationary news, that can drive interest rates down. A fear of a slowdown or a recession will drive rates lower. That's what's been happening since December. And we're going to show a chart on here just a minute ago. And remember what I said, be careful what you wish for. A big drop in rates usually means bad economic news out there, right? So we don't want them to drop too fast. So here's an historical chart back to the 1990s with interest rates. I'm sorry, back to 1971. Anybody ever told you they had an interest rate at 17% in 1981? Y'all heard that? And I used to walk to school barefoot with one shoe, backwards, in the snow. You know, back in 1985, my rate was 17%. Nobody cares. They don't care. If you think about it, I mean, that's like that old saying, like, I used to walk to school barefoot backwards with one shoe, right? Did you really care as a kid that your parents said that? No, you didn't care. You only care about where you live right now. And that's where borrowers are right now. They care about now. They don't care that a majority of our buyers, they weren't even alive in 1981. Let's be honest, right? Somebody that's 35 years old, they were barely alive at that point. So And there's a lot of our borrowers out there that are in that boat. So that's something that happened before they even existed. Now, this is from 2014 to now. As you can see, we've been bouncing between 3.5 and 4.5 over these last couple of years. We started to see a big trend upward as the economy was really taking off. Then there's started to be some fear of inflation. And that big dip over there on the end, that's what happened since December of this year. And in fact, guess what happened in December? Fed raised rates, but our rates dropped. So y'all have heard me say this before, to those of you who've heard this. If you're on Facebook or you're on social media and it says the Fed raised rates, and you go on there and say, oh my gosh, the Fed just raised rates, you better be careful, go buy a house right now. That doesn't always happen. That our rates, they don't control our rates. There is a relationship between the two, but your rates could actually drop. And about 65 to 70% of the time when they do have the Fed raises rates, mortgage rates actually drop within the next 30 days. Because all the anticipation of what the Fed's going to do and what they're going to say has been built up, and so and then it comes back, right? So that's good news. Now, that doesn't always work that way. Sometimes rates do continue to go up. They had a lot of Fed increases last year, and we're going to talk about that and some of the probabilities of that here in just a few minutes. So what is driving it? Inflation. This is an inflation consumer price index from 2010 on. As you can see, back in 2011, 2012, we had some pretty good inflation. That's the blue one. It dropped in 2015. It's been steadily climbing there. The red line is actually wages. When we have inflation, we want to see wages move higher. It's called wage inflation. Rates are very sensitive to wage inflation, though. If you have wage inflation, it means all it does is double up on the inflation out there that's already happening, right? But we really haven't seen a lot of wage inflation nationwide. But I've got some interesting charts here in a minute. I'm going to show you of what it looks like here in Central Texas, which is good because remember, mortgage rates move off national news, not local news, right? National news is what they move on, not local news. So if we can keep wages flat for everybody else, right, but ours continue to go up to help some of this appreciation, to wipe out, some of that affordability issue with appreciation, that's a good news. I'm going to show you some interesting numbers here in just a minute. So talking about recessions and expansions, we're about to be in the longest expansion in U.S. history since like the 1900, right? Since they started recording them, the longest in history. So your first thought is, well, if it's the longest in history, it's about to end right now, right? Maybe. I don't know what's going to happen tomorrow, but we have a pretty good idea that it's not going to happen tomorrow. They're predicting our GDP growth this year is going to be about a little over 3%. Next year, this year, 2019, they're predicting 2.5%. Next year, they're predicting 2%. Now, going out to 2020, that's just a very good educated guess at this point, right? Did anybody know what the definition of a recession is? Anybody? Thank you. I knew somebody knew, because I didn't. No, I'm just kidding. I knew. So we don't see that happening anytime soon, right? So I think this expansion is going to continue. I think that the Fed is afraid that they did too much last year. So the probability of more Fed increases, rate increases next year is dropped significantly. So this is an interesting chart, and I'll show you a little bit better one here, but it's a little easier to understand. Right now, the Fed funds rate is at 2.25 to 2.5, right? The chances on January that they're going to keep them the same is 98%, right? That they're going to raise it, it's zero. That they're lowering it is actually 1.6%. So as you move through the Fed and their meetings over the next year, right? This is a percentage chance it's going to stay the same, rise, or go lower. And actually, if you get down here to the end of 2016, it looks like there's a better chance, there's a better chance it's going to stay the same, but a better chance that it's going to lower than it actually going to hike. So I've heard some of the comments out there lately are talking about that the Fed, they think that they may have overstepped their bounds with too many of them last year, and that there won't be any Fed hikes this year. And reminder, in November, everybody was saying they were going to do 4. Now everybody's saying they're probably not going to do any. That's how fast the market can change. That's how fast their perception can change. So what is this going to look like 3 months from now? Who knows? What's the news going to come out? What's the economy going to look at? What about the trade wars with China? How is that going to affect it? But right now, this is just a great example of how it can flip on a dime from 4 and maybe rates in the high 5s or 6s, to no Fed hikes, rates might actually drop and stay where they are, which is good news for us, right? But I would also use this information with your buyers, your potential clients, that we may have a great window here of opportunity before it does happen. Here's a graph of that. It's kind of the same thing, but we put it on a graph. The up arrow is no hikes, and so this is from October of 18, so this is just last October right here, right? So the chance of a hike at that point was almost 40%. As soon as the beginning of December popped up, that dropped. The percentage change is they're going to go up to almost nothing, and the no hikes went way through the roof. And this is they pull a lot of the Fed guys out there, the voting ones, to see what they're going to do. So that's how fast things can change with it. So always keep an eye on the news. Just because we're talking about it right now doesn't mean that something in the next 6 months on the economic side can actually change what rates are going to do. The good news is, right now, we're stable, and that's the good news. And I got to tell you, when we're out there quoting interest rates to people, the difference between a borrower when you quote them 4.99 and 5%, 4.99 or 5%, it might as well be from here to the moon, right? It's all about perception. So keeping those rates into the 4s, right, which I think is a healthy number. I think 3s is not a healthy number because that denotes something's wrong. But keeping them in the 4s is going to help the borrowers say, okay, that's good, a 4% rate's good. Even though in the long term, we know 5% is not that bad either, right, over long term. But who cares about that, right? Those are rates from before. All right, housing affordability. I've said this until I'm blue in the face. What drives housing? Jobs drive housing. Consumer confidence is gas. So how are we looking out there when it comes to the economy and what's going on? This is the unemployment rate for the Austin area. In November, it hit 2.5%. So you either don't want to work or can't work if you're unemployed right now. And everybody thinks that this is a really, really good thing, right? By the way, the gray bars are recession years, right? Everybody thinks that that's a great thing, that our unemployment rate's at 2.5%. Well, it's actually a problem, right? Number one, if we have new companies moving here, they're not going to choose Austin, right? Because how are they going to get employees? They're going to have to take an employee from another company, and how do they do that? They're going to have to pay them more. Wage inflation, right? They're going to have to pay them more to do it. The good news is we have people moving here from out of state. Anybody dealt with an out-of-state borrower lately, right? I think all of us. I think since 2004, we've had 800,000 people added to the Austin metro area. 800,000. They all go on MOPAC every morning. I see them. Unemployment rate 2.5%. It's good, but it's not good. Luckily, there's new workers coming into the Austin area to absorb the new jobs being created right now. So we got to make sure we stay on top of that. And anybody seen the U-Haul index? Texas was ranked number 1 for 2018. Everybody know what the U-Haul index is? Yeah, the one-way trip. So the cars to get here to Texas from California, it's going to cost you a lot of money. But if you want to take our truck back, we may pay you, right? So it's interesting to see. We've watched that U-Haul index over the years, but Texas was number 1 in that. So that just means there's people moving here, but we already know that, right? This is the unemployment rate. This is for the last 5 years. Obviously, it's seasonal, right? It goes up and goes down. That's the lowest we've seen it in a very, very, very long time, which is good. But one of the things that's a little nervous is that if you notice this chart here that has the recessions in it, every time the unemployment rate drops really, really low, there's a recession right around the corner, right? Now, I don't know if that's going to happen anytime soon, which we don't think it is, but you never know. We were talking about consumer confidence is the gas that drives it, right? This consumer confidence chart is through now. It didn't pick up 2018 on it. We're at the highest consumer confidence levels since 2001. Anybody living here in 2001, right before the dot bomb, right? I have my Dell stock just split 5 times. Right? Everybody was talking about I'm an internet guy, I'm a .com guy, I have all this money, right? And all of a sudden it exploded right after that. But consumer confidence was high back then. Everybody was saying Austin's a new Silicon Valley, everything's going great, right? Let's put a wall up on MOPAC. It never happened until recently. You know, I have a story about it. So Kevin, did you help me with that one? Maybe. Sell it, you did at least, thank you. So in 2002, I bought a house that backed up to MOPAC in Highland Park West. And I'm thinking, oh good, they're going to put these sound walls up and I'm going to make some money. And they were talking all about it. So I bought this house, fixed it up, sat down, go, okay, when is the sound walls coming? Then they shelved it for like 12 years. They just got them all done. I had to get out. Thank you, Kevin, for helping me get out of that house.
Texas or national?
This is national. What's that?
Thanks for selling it so they finally put up the sound wall.
Yeah, oh, exactly. That's exactly what happened. Right after I sold it, now the sound walls are coming. Great. I was talking a minute ago, there's 800,000 people have moved here since 2004. The interesting note is, and I know you guys all know this, that in 2004 there's about 116,000 listings put in the MLS. In 2018 we had about 2.2 million people living here. There's only about 91,000 listings put in. So 800,000 people more and less listings out there, but we already know that that's a problem, right? And new construction is well behind to keeping up, especially on affordable housing out there in the Austin area. Monthly housing supply, this is nationwide, so not everybody's having this problem, by the way. And I don't think it's going to get any better. So what I like to look at is there's a couple of things that would help our inventory numbers, right? Number one, new construction, affordable new construction. Why do I think there's not going to be any affordable new construction anywhere close to the interior of Austin? Well, I call it the 4 L's: lumber, labor, lighting, and land, right? Lumber, up until just recently, lumber had gone through the roof because of the NAFTA talks and some other stuff between us and Canada. The majority of our lumber comes from Canada. Luckily, some of those prices have dropped. Labor, it is tough to find labor here in Texas. Because of some political changes, a lot of the people that are some of our skilled workers in the construction business are afraid to come back, right? And so they're not. And it's a lot more expensive. Expensive labor means expensive house, right? Lighting. Did you know that the majority of your fixtures and your faucets and everything else and the hardware that goes in a house is all made in China because it's made so cheaply? Anybody watch the news about what's going on in China right now? Right? There's a tariff war going on right now. And if the government has its way, then they're going to put these huge tariffs on China's goods, right? Which will raise the price of those, which will raise the price of the house. They're hoping that maybe United States manufacturers can pick up the slack, right? By increasing those prices, it allows us to create those. But in the meantime, we're going to have to deal with more expensive lighting and fixtures and everything else that goes in the house, which makes the house more expensive. And land, obviously, they're not making land anymore, right? That's a problem. Well, I take that back. They are making land in China right now. There's islands off the coast of the Philippines that China is actually making islands out there. They're dredging up reefs and making islands. Then in, I can't remember, Dubai. Thank you. They're actually making land there too, but not here. Not here. That doesn't help us over there, right? They're not making more. Now, you know, a lot of the builders are coming up with interesting ways to get the houses cheaper. One of the ways I don't like is that I saw a tax rate of 3.8% the other day. 3.8% on a house. Because they have these new utility districts. It's called the PEDs, I believe is what they're called. And they are, it's partially the way the builder gets involved, right? And gets some of that revenue afterwards. And so they can deliver affordable housing. So be careful when you're selling new construction. You know, the difference from a home buyer between 2.5% and 3.8% is a big deal, right? Not always look at the purchase price. Educate them to look at also the tax rate in those areas too. I couldn't imagine. You know, tax rates fluctuate all over Austin. There's a place up in Cedar Park off Hatch Road where one side of the street's like 2.5 and the other side's 2.1, right? That's a big difference. That's a huge difference in somebody's pocketbook. And remember, unlike an interest rate, that tax rate's forever on that property. Yes, ma'am.
So if you have a client who's 100% disabled veteran and they don't have to pay property taxes, they're still going to have to pay those utilities?
No, they don't have to pay anything.
Okay.
Yeah, they don't have to pay any of that.
Okay.
It'd be just like living in a PUD or something like that. Yeah, they don't have to pay any of those fees. And as they should not, right? So it's going to be tough. Now, another thing that we've talked about recently too is that how many investors bought houses over the last 8 or 9 years in Austin? A lot of them, right? Just a ton of people. The smart ones bought in 2009, 10, and 11. Those properties, some of them, I would guess, would have actually doubled in price. Their tax bills are really starting to hurt them right now. I'm hoping that we'll see some pain on that side from those investors who will now flip those to owner-occupied units and put those on the market and sell them. There's another way I think we can get some labor. We can get some inventory out there, but I'm going to save that for just a few minutes. It's actually a cause I'm taking up. I'm actually having lunch with one of the state legislatures on Monday to talk about something I'm going to be talking about here in just a few minutes. Let's look at some stats locally here, and these stats are from the Austin MLS today. Thank you, Kevin Bound, for getting those for me, finally. So this isn't months of inventory. This is like a hotness ratio, right? In the city of Austin, there's about 1,504 single-family homes listed. There's 938. We're at about 1.6 ratio. That's really, really hot. I was looking at some numbers from December, and we're way down on the number months on the inventory right now, by the way, and we're up actually on the pendings. The entire MLS for single-family homes is 6,400, but 2,656 are pending sale. That 6,402 number is actually really down from December. What is out there? We need more inventory out there, and I know we've been seeing some price drops. Have y'all? I was talking to somebody the other day. They've said there's like 80 price drops a week in the Austin MLS or something like that. Anybody else seeing that? I think that's the sellers just realizing that they've capped out on what they can sell the house for, right? They're realizing their house isn't selling because you priced it too high, right? Listen to your real estate agent. He's going to make sense for you. She, yes, sir? Uh-huh.
Those are all economic in a way, right?
They're what?
Economic forces?
Those are economic. Yeah, so it's the cost of labor, the cost of lumber, the cost of lighting, and the cost of land. Right. The cost drive up. What's that?
Right now the prices are higher because of that. Do you see that same single family house going down in value?
Well, the house itself depreciates, so yes. So you mean if these come down, will they lower their prices?
Because of these pressures, the price is higher.
I think that on a single-family home in a neighborhood where it's based upon demand, right, that it shouldn't hurt your values at all, that these are coming down, unless the builder starts putting homes in that same neighborhood that they're exactly the same as yours but brand new that cost less. But I don't see why a builder would do that, right? They're trying to maximize their profits. So I would only see if it's in the actual same neighborhood or close proximity that would actually happen. They're going to get away with it, right? So if they can get the extra money, which, they deserve, they're in business. They're in the business to make money. Does that answer your question, Michael?
Thank you.
You're welcome. So let's move on to this. Let's talk about homeowners of the future and home ownership rates. So I know you're going to say nobody cares, just like the interest rate things, but back in the 1970s, the median home value in Austin was $17,000, and the median income was $8,700. And you're like, yeah, nobody cares, right? But it's kind of interesting to look at. In the 1990s, when I bought my first house, the median home value was $79,000, and the median household income was $29,000. Home ownership rate was 64%. And if you look at these home ownership rates since the 1960s, so like 50-something years, we've seen home ownership rates in the 60%, 61, 62, 64, 64, right? That's kind of where it is nationwide. So that household income number is so low that I'm like, how did we live on that kind of money? I guess we didn't have to pay for cell phones. We didn't have to pay for internet. We didn't have to pay for blah, blah, blah. Here's what it is now, and this is nationwide. We're in the South region, according to the Fed, South region. Median income is now $62,000. Affordable home value per them is $245,000. Median sales price is $291,000. Average is $337,000. This is according to the Fed, right? How do we get past all of this appreciation here in the Austin area? Well, the only way we can get past it if rates drop to 3 or 2%, but we don't want that, right? Because that means there's something bad going on in the economy. Nobody's going to buy a house. What we need to see is wage inflation locally, not as much out of state, so the nationwide news doesn't pick up on it, right? It drives rates if we see too much. But locally, here's what we've seen in the Austin area. Since 2009, the per capita income here in Central Texas, right, for Round Rock, has increased 35% since 2009. Back in 2002, 2003, it was down. It was right at about $34,000 a year. So now we're sitting up around 50. I think it's 55 or 54% is per capita income. That's really good news as long as we keep seeing this go up to counteract the inflation on the housing, the affordability, right? The houses go up. Here's an interesting chart we found. This is Austin and the surrounding areas in 2009. Austin's median income, or per capita income, excuse me, was $39,000. College Station, $29,000. Houston, $43,000. Killeen Temple, $37,000. Waco, $30,000. If we fast forward, again, San Antonio at $34,000, till 2017 is when this data is from, we're up to $54,082. San Antonio's up. Fort Hood kind of remains the same. College Station's up, and Houston's up. I'll go back and forth. So 39 to 54. That's wage growth. That's here in the Austin area. It's really happening. Not everybody's seeing it, but a majority of people are seeing this. They're making more money than they did in 2009. That's good news for affording a house. However, if the per capita income is $54,000 and you have two people, how much is that? $108,000 a year? Does that buy you a $500,000 house? If you're stupid, it does, right? But typically, that's still not keeping up with the value. What's the average home price or median home price here in Austin now? Anybody know? 320. What's the average? Higher than that, right? It's getting way up there. So it's good that we're seeing wage growth locally and we're not seeing it nationwide, because remember, if we see it nationwide, it's going to drive interest rates up. But if we can keep it locally, right, we'll take it, because it doesn't have all the repercussions that it would if it was reported nationwide when it comes to interest rates. Okay, I have a typo on this thing. The average home price in Austin's up 53%, not 153%, in Austin since 2011. 53% is still a big number for the average home price from 2011. All right, so who is the borrower of our future? And that's one of the things that we've said around, the loan officers and our marketing people have talked about over the last probably 2 months. Who's the new borrower? And obviously the big key word out there, the word everybody talks about is millennials, right? Who's a millennial in here? Raise your hand. I'm about to make fun of y'all. No, you are not. Yes, so you're 34. So, okay, I'll let you in that one.
I'm right on the edge.
Yeah, you're right on the cusp. So it's in but the chart, the information I got here. Anyway, if you're a millennial, I'm about to make fun of you. I'm not. I'm just kidding. Who's the borrower of the future? Well, I don't know if it's millennials, but I do know that it's younger people are going to be buying houses, right? And let's talk about some reasons why I think that's true. First of all, let's identify what the new buyer is, in my view, right there. More people are staying at homes. With more millennials now living with their parents more than a spouse, they represent a reservoir of pent-up demand for housing. A lot of people are, because rents are so high, they have no other choice but to stay at home, right? Hopefully they're not in their basement playing Xbox, right? Or they have multiple roommates. Yeah. I know of a house I have a house with a basement. It's not a very big basement. The makeup of the U.S. is changing. We're about to become a majority minority. In fact, they're telling us by 2020 that Hispanic Americans will make up 50% of first-time home buyers. Think about that. Might be time to get your Rosetta Stone out and learn some Spanish, right?
Of the world.
You've got this covered already. People are more mobile. I can't tell you how many people that we've done lately who live in California or other states who are moving here, but they work remotely so they can work anywhere they want. So they're choosing to live in a place where their tax benefits are better, which one of those places is actually Texas, right? We're seeing a lot of mobile workers, and a lot of these younger workers tend to be more mobile when it comes to their job. It's like the gig economy, they're calling it, right? They go find something they really want to do, and they start doing that, then they go to the next job, and they go to the next job. From a banking perspective and a risk perspective, that's kind of scary, right? That means they're not as stable as somebody who's more career-minded, right? It's going to be at their job for 15 or 20 years. So I think Fannie, Freddie, FHA, all the mortgage banks are going to have to take that in consideration moving forward, and maybe change some guidelines to conform to this new buyer who will be changing jobs more frequently. You know, in the past, if you change jobs 3 times or 4 times in a 2-year period, that's a huge red flag, right, for an underwriter. Oh, they're not stable. Well, guess what? The younger buyers now, that's completely normal for them to do that. So you've got to change your underwriting standards and how you look at it when you're underwriting a file. We're sharing more, from hailing an Uber to ride booking of rooms or Airbnb, the sharing economy. It's interesting. I've seen a lot of people who have multiple jobs that are younger too. I think every one of my Uber drivers, at least 50% of my Uber drivers, I've also gotten into real estate or the mortgage business over the last 6 months because I like to talk to them, right? It's true, but there's nothing wrong. They can earn some great money, right? My daughter was doing an internship in Nashville this last summer, and after the fact, she told me she was Ubering for 3 weeks or 2 weeks for a festival. I almost killed her. But a lot of people, they don't, and she's like, well, what's wrong with that? I've made like $600. I'm like, really? $600? How many miles did you put on your car? But, you know, they're doing more, and we have to change our mindset, especially from a banking point of view, of how we deal with these buyers, because having 4 or 5 jobs is not a bad thing, right? How it used to be. So where are the people coming from that are moving here? So I believe they're going to be younger. That's going to be our buyers for the future. I believe also they're coming from other places, a lot of them. California, New York, I've seen a lot of both of those states recently. And a lot of these are states where the state income tax rate is very high. So this is the state income tax rate by state. California's at 13.3%. Their top tax bracket's $200,000. If you make $200,000 in California, you're paying a 13.3% tax, state income tax, right? That's a lot. Seems like a lot to me. Well, up till 2017, you got to write this off on your federal tax returns. Helps out. As of this year now, your SALT deduction, which are state and local taxes, is maxed at $10,000. So that means that their state taxes and their property taxes can't exceed $10,000. Well, you're like, well, they don't have property taxes there. Yeah, they do. Their average property tax is 1 to 1.5% in California, set at the time you purchase the house. How much are houses in California going for? Yeah, well, in some of the bigger cities, like $800,000, right? But let's just call it $1 million just to round it up.
Even in San Francisco, $1 million.
So right there, if they're paying 1%, that's $10,000. They don't get to write this off. And somebody if there's a high-tech worker there making $400,000 or $500,000 a year, and his property tax is already the only thing he could write off, and probably only a portion of that, and now he take a pay cut, what do you think he's going to do if he's working remote? I'm going to go remote my ass down to Austin, right? Or Dallas or whatever it may be. They're moving here, and we see it all the time. So they're going to be younger, they're going to be more mobile, and they're coming from other states. So this is one of the things we got to think about. How do we get them, right, to you, to us? I have no idea. And so I don't have it on the slide here, but that's something to think about, right? Okay, let's talk about why I think that younger population is going to be the big one out there. Remember earlier I said home ownership rates are in about 61, 62, 64%? This is arguably the different generations and the dates that they fall on. I like this one because it put me in Generation X instead of in the baby boomers. So that's the millennial generation there, arguably on the dates, right? And that's Generation Z, born in 1997 and later, right? I've seen some other charts where the millennial generation actually ends in 1999, and where that millennial generation is like 91 million people, not 71 million. But those two groups there represent double what not double, but a lot more than Generation X and baby boomers are, right? The problem is, not the problem, what it is though, is that these people are already owning homes, right? Those are your first-time home buyers over there. And let's look at home ownership rates by generation real quick. Boomers up here. I'm sorry, this is the labor force one. I'm sorry. So this is the people in the labor force out there. I have a different slide we're going to look at. So boomers are declining in the labor force out there. Millennials are on their way up. Gen Xers are already there. Silent generation, obviously, they're very, very low. And then post millennials, we haven't hit that yet. But the millennials here, they've actually crossed higher than Gen X and the boomers now for the number of people in the labor force. So there are more millennials in the labor force than there are boomers and Gen Xers now, right? Those are younger people, first-time home buyers. This is the people we've got to start thinking about. And we've got to start thinking a little bit different, because what's important to them buying a home may be different than what we think of when it talks about buying a home. This is the one I was going to talk about. Home ownership rates in the United States by age group. 65 and older, 85%. 55, 64, 75%. 45, 55, 70%. United States as a whole, about 64%. People 35 to 44, 58%. People under 35, and this is down to 21, is only 35% home ownership rate. I see that as an opportunity, right? That they don't own a house. Listen, the historical rate, no matter what generation you've been in, is about 61%, right, over the last 50-something years. there's room for this to grow. It's like the two shoe salesmen going to Africa, and one guy goes, hey, nobody wears shoes here, I can't sell shoes here. And the other guy's like, yeah, nobody wears shoes, I can sell shoes to everybody, right? There's opportunity here if you look at it to take care of these people and some of these, right, and get them into homes, because that's one of the reasons I think that's our buyer of the future, is that younger generation out there. And here's the home ownership rate over the years with the people less than 35 years old. It's way low than what it should be right now. And I think part of that's a product of when it went way above this line here, that's when money was real easy, right? People made mistakes, and I think some of the younger generation now, they still remember it. Now, if you think about it, 2008, when the big recession started, was what? Almost, like, it's coming on 11 years now, right? So if you're 30 years old, you were 19. I remember when I was 19, I didn't look at I don't think I watched the news, I didn't do anything, right? I think I watched MTV and went out, and that's about it, right? I didn't pay attention to all that stuff that was going on. So, good opportunity here. That's why I think those are the guys we got to go after. We got to find a way to get in front of them.
Well, and for you guys got to do more rehab loans, because all the millennials are going to buy the baby boomers and the older people homes and want to rehab. And
They do, and that's okay. In fact, our rehab specialist, Walt Brewer, is right there. That guy is the king of 203Ks, the Streamline, the Full, the Fannie Mae stuff. He knows them back and forth. In fact, when any of the loan officers in our office have one, they just give it to him, because they're tough to do, but he does them all the time. So if you have one of those. Right, Walt? That's right. Today's borrower, 40 to 45 years old. Tomorrow's borrower, less than 35. Remember we talked about 50% of the first-time home buyers are going to be Hispanic Americans. College educated both, but today's borrower is more career-oriented. That's where our underwriting guidelines trend to. College educated still in the future, but job to job to job, or multiple jobs at one time, right? They're actually going to be earning more income, so they say. Married, well, they'll probably live in multi-generational homes or live with roommates, right? Here's the thing that was interesting. Today's borrower, 740 FICO scores, but we see this all the time. In the future, though, you're going to see less credit-worthy younger buyers. Why? Because if you're jumping from job to job to job, it can be unstable. Your income fluctuates a lot. Not everybody's perfect with their finances, and so we may actually have to deal with lower average credit scores for buyers out there, along with them changing jobs multiple times and just understanding that that's the new norm, right? So make sure you're dealing with a mortgage company that knows how to do that. Change the borrower landscape. I think this is probably 80 or 90% now. Use online process for the application process. 50% of the work will be automated. This is just some interesting stuff about the gig economy. I'm going to send this out to everybody so you can look at it. I just think that there's a huge opportunity that there's pent-up demand for first-time home buyers. And as we see rents increase in the Austin area, that's going to really help some of those people make decisions to buy other homes, right? Hopefully we can contain the affordability and have some more inventory, though. Okay, so what could stop? Yes, ma'am.
So I have read some things that say that, the younger buyers, younger people are not interested in buying because they don't want to maintain the yard, they don't want to maintain the house, they don't want to do those maintenance things because they want to spend their time and resources doing other things. So, I think we really need to change the product.
Yeah, townhomes, condos. Yeah, small. And I agree with you 100%. And I think we're seeing, obviously you look at the amount of condos here in the Austin area. There's probably 1,500 units coming on this year downtown alone, maybe 1,000 units. But yeah, I saw an article this morning talking about townhomes could be a good example of that. Garden homes with 0 lot lines. Because I agree with you. No, I don't even own a lawnmower, right? But I'm not a millennial, just FYI. I agree with you 100%. They've got to have new products out there. I know some of the builders are doing some affordable stuff where instead of it being a custom home, right? Not that they're really custom homes, but they build a whole street all at one time. So the trades to just go and it saves them money because they're more productive, right? They can sell the houses cheaper, but you get what you get. It's like getting an apartment, right? But you still own the property. That's why you're seeing a lot more condo regimes out there too, I think. That's how they get those prices a little bit cheaper because they can use a little less of the land per deal.
I think the regulatory climate on what will you be allowed to build in certain areas by the entity in charge has to change as
Well, and you've got to be careful too. So I was at we were at an event. We had a live broadcast of the radio show from off Crystal Falls Parkway with an affordable builder. We were talking to the builder, and he was saying, "Yep, we tried to get these as low as possible for these condos out here. Everything was going great. The city was all behind us. Affordability. Then the city came by at the last second and said, "Oh, but you know what? You need to be green. So you need to put these HVAC systems in. You got to put these windows in. You got to put this kind of water system in. You got to do this, this, and this." And all that added up to a huge cost. And they had to skimp in other areas, right? Do you remember that conversation, Kevin? Yeah. I mean, so we've got to be careful with the politics of it, right? Because let's be honest, there's a lot of people moving here from other states that have different political views and how things are done, right? So I think the political landscape is also shifting here in the Austin area. And so yes, do we want to be green? We want to have a good carbon footprint? Absolutely. But we also have to have affordability. So which one outweighs the other? I think affordability probably does that right now. Not that we should put somebody in a bad house, but all right, let's move on. What could stop us? What could help us moving forward? Let's look at debt in the United States. The orange number is mortgage debt in the United States. It's a little under $9 trillion. That's with a T, right? The one that we're all worried about is that red one there. That is, anybody know? Student debt. I can't tell. I looked at a loan application for a borrower the other day. He was 2 years out of law school, had $186,000 in student loans, was making $64,000 a year. I hope he has long-term plans for that, right? It's scary how much student debt is out there. I have 2 kids at Baylor right now. Trust me, I know how expensive college is. But it's only for 1 year. I have a freshman and a senior, so hopefully my daughter will graduate at the end of this year. So that student loan debt is weighing on a lot of people, right? It hurts them when it comes to the qualifying aspect of it. Fannie Mae's just changed their guidelines recently that help out with that, but that doesn't relieve the debt from these buyers, right? And I think something's got to be done about that. I'm not sure what though. So let's think of things that are helping right now. Mary said consumer confidence is what drives housing. Everybody wants to feel good. You want to have more money in your 401k. You want to have a bigger paycheck. You want to have more money in your savings. You want to have a job that you love. That makes you feel good, right? Well, if you have a lot of equity in your home, that makes you feel good too. The green is the amount of outstanding mortgages in the United States, or the blue, that's $9.8 trillion. The green is the amount of home equity in the United States. It stands at $13.7 trillion. People feel good. You divide that out by the number of homeowners, people have equity in their homes nowadays, unlike what they used to. Now, you're saying, okay, look at that big bubble over here in 2008. Yeah, I know, but that was completely different. It had nothing, that had to do with the ease of financing, just like student loan debt is a bubble, because it's so easy to get a student loan and the colleges know it, right? So they just charge more. That, I think, all the people who have bought a house in the last 7 or 8 years have qualified at the day of closing, right? And have been vetted. Y'all are psychiatrists. I'm a proctologist. I go deep on every file to make sure that I know that sounds gross, but it's true. They qualify, so it's different than that. So that amount of home equity out there makes people feel good, right? We see wage inflation right here in the Austin area. People feel good. We see home equity, especially here in the Austin area. People feel good. People have money in the bank, right? So we have that wage inflation. They're making more money. People feel good. That's why I think the Austin area is going to do very well, and there's no recession on the horizon. There will be one at some point, but I think more in Austin could be more of just a pause or a slowdown, right? Here's that student debt I was talking about, $1.52 trillion in a year ago. In 2006, it was 0.5. It's gone up $1 trillion, since 2006. How many colleges are there in the United States? What do you think? 1,000, 1,500? Take 2,000 and divide it into a trillion. See how much each college is getting. I mean, it's a lot of money. $1 trillion is a lot of money, right? And the reason it's out there is because the government's made it easy to get them. Then the schools know, hey, there's free money. We can build this and make it look cool and charge twice as much, right? 58% of all graduates have debt when they get out of school now. Average student graduates with $28,000 in debt. I think that's low. I see it way higher all the time. 1.5 trillion in outstanding debt, second only behind mortgage debt. But remember, a mortgage at least has a house behind it. right? A student loan has an education behind it and some books, right? That's not tangible. I mean, it is. You can sell that for a job, but it's not like it's not like something you can hold in your hand. The average default rate, this is the scary part, it's 11.5%. That's a year ago. 11.5%. If the economy's doing well, people have money in the bank, and they're feeling good about everything, yet our default rate's 11.5%. What happens when that recession does hit? And some of these big tech companies and these other companies slow down a little bit, start letting people off. That could jump overnight, quadruple, triple, right? So if we're doing so good right now in the economy, it's 11.5%, think about how bad that could get on the default rate when the economy does slow down a little bit, and it will at some point. And that's what a lot of the economists are talking about, and that's why they're so afraid of this, not about the current default rate, but what happens when the economy's not roaring along like it supposedly is right now, right? Something to think about. I think they should the federal government should just wipe it off the books, right? No. All right, let's look at what else could hurt us. Like I said, a recession. So, y'all heard the term inversion? The rate inversion, right? Signal of a pending recession. Well, I went back to 1974 on this, and this is the spread between a 2-year Treasury and a 10-year Treasury. The spread's either 0 or as high as 3.5%, right? So if you're an investor and you can invest in a 10-year government-backed security at 5% or a 2-year guaranteed at 5%, which one are you going to do? You're probably going to take the 10-year, right? Because it's guaranteed for 10 years at 5% instead of just the 2-year one, right? So what happens is now in what's happening lately is every time you see this inversion where the 2-year is paying back more than the 10-year, about 18 months later, there's a recession. Happened here, 18 months. Happened here, 18 months. Happened here, 18 months. It doesn't show on this chart, but it just happened. So are we 18 months away? I mean, if the charts were right all the time, right, we would be 18 months away. But there's other factors that come into it. Just know that all of these leading indicators are telling us that we're 18 months away. That's why I keep saying mid to late 2020 for a nationwide correction. Does anybody know how long a typical recession lasts?
A year?
No, 6 months to 9 months at the most.
That's the millennials that might save us from this recession.
Yeah, of course. I think we'll all save each other. How long does the average expansion last?
10 years.
7 years, right? We're well past that one, which is good. But I'm okay to have a little bit of pain, to have a big time gain, and not worry about a future recession coming again, right?
We had a mini recession, it's just Austin wasn't affected. So we could have another mini recession nationwide.
Well, there hasn't been one nationwide. There might have been a slowdown, but we never had negative GDP growth for two quarters since 2008. It's the last time it happened. It's gotten close, I think, a couple of years ago, but it wasn't.
That's what I'm saying. In 2008. Gotcha.
Yeah, 2000. Now
Gotcha.
that was 10 years ago.
Right. I was too young for that.
But we just have to keep it in mind, right? And be cognizant of that it could be here in the future and prepare ourselves for it too, right? I mean, we're all on commission, I assume here, right? Save your money, right? From 18 months away. Here's an interesting chart I pulled up. It's the per capita gross domestic product for Austin, San Antonio, Dallas, and Houston. Austin is in the green right here. This is the recession. It has gone way up, right? Our per capita gross domestic product. It's a GDP basically for Austin, right? In fact, we just passed Houston last year for higher GDP than they are, and we're keeping up with Dallas now, which is a big deal. And this is San Antonio down here. They have a lot of work to do, but this is good when we see this gross domestic product. So we're producing enough here to keep that economy chugging along. That GDP, that's good for us. So that's same thing that we look in for nationwide. This is by metro area. It's nowhere near going into recession here, not locally. But you know what happens though, right? Perception is everything. When nationwide we go into a recession, people watch the news and it's all about everywhere, right? And they're going to go pick the worst little spots, even though you could be doing really well. Everybody's perception and what happens to consumer confidence when it's woe is me, and everything's going bad, consumer confidence will drop. All right. I don't know if you remember. Everybody remember the hurricanes a couple of years ago that hit Houston and Florida and the fires in Napa Valley. The news was so bad for a 30-day period that it actually drove consumer confidence down on its own. And we actually saw a little blip in the housing industry because of it. Because hurricanes hit Texas. One of them hit us twice. There was 60 inches or whatever. The Napa fires burned down, killed a bunch of people. The hurricane hit Florida. All the national news, that's all they were talking about for 30 days. It actually drove consumer confidence down. We don't want that, right? All right, so as to wrap up, I'm almost done. About another 25, 30 minutes, I think. I'm just kidding. A couple things I want to go over. We need more inventory. I'm going to talk about this over 65 conundrum, and investors, I hope investors are going to decide to start cashing in. It might be a good exercise for you to find investors out there that bought 8 years ago, 7 years ago. Talk to them about the stuff that we're talking about today. Might be a good time to sell, to get them off the market, right? To get those homes back on the market. That way you'll be their kind of advisor, real estate advisor. Hey, might be time to dump it now and go put it somewhere else. 4Ls, we got to watch out for that. We need wage inflation to counter upward movement in price, but I'd rather keep the wage inflation in Austin and not everywhere else. Sorry, everywhere else. The over 65 conundrum, when it comes to inventory. I'm having lunch next week with one of the state legislatures. This happened, the way I thought of this, it happened when I was talking to my mom about 2 or 3 years ago. She wanted to sell her house. My mom lives off Barton Hills Drive behind Zilker Park, about 5 or 6 houses from the Greenbelt entrance. She bought the house in the late 70s for like less than $100,000. She's on a corner lot. It's huge. 4-bedroom, 2-bath, ranch-style house. House next door to her just sold for $787,000 for the lot, basically, right? My mom's like, hey, I want to sell this house. I want to go buy a condo, so I don't have to deal with all 4 of these bedrooms, this big giant yard. The house is starting to get older, blah, blah, blah. I go, Mom, how much are your taxes? She said $7,000 a year. I go, that's great for this area. She goes, I know. And she goes, I go, if you move, your taxes are going to triple. She goes, why? I go, because you're going to reset at the new property. And she goes, well, I can't afford that. So guess where my mom is? She's still in that house, still having to deal with all the upkeep and maintenance and this big giant house that she really doesn't want to live in, right? She wants to live somewhere a little nicer. Not that it's not nice, but, it's a little smaller. She can upkeep on it and extract some of that equity from her house and so she can enjoy it. But she can't do that. The flip side, like Zilker Elementary and some of these other small elementary schools around town, they're in the verge of almost closing down, or some of them are, because they don't have enough kids in the neighborhood to go to school there. Because all the people that live there are all older people who have their taxes paid. It happens in Terrytown, happens in Crestview, happens everywhere. They don't want to move out of Austin, but they can't afford to move because their taxes are set. So one of the things we're talking to Eddie about is about putting forth a bill, because they're real into finance right now, to allow a person to carry their tax bill, the dollar amount, to a new house as long as it is smaller. Right? So think about what that does. It allows my mom, we'll use her as an example, to go get into a 2-bedroom condo that she can manage, extract from her property, keep her property taxes the same. It allows that house over where she lives to now sell for hopefully $900,000. And now the county's getting money more than they were getting from her, probably quadruple than they were getting for her, right? And all they had to do was trade off a smaller house to let my mom live in and get more tax. So, and then now you have families moving into these neighborhoods, right? Right? And then you have the schools reinvigorated. I just think it's a win-win altogether. So we're going to be we talked about it on the radio show. We've done a little bit of social media about it. After I meet next week with Eddie, we're going to put it out there a little bit more. But if you see anything about it, help us kind of spread the word about that, because I think it's a really good idea. And for all of us, right, it also would free up a lot of inventory out there. A lot. There are so many people in my mom's spot in the Austin area. So just keep that in mind. Any questions? Yes, sir.
For your Supreme team, and mortgage lenders in general, given the millennials and also the future trend towards the new home buyers, what's the biggest changes you're making or you need to make from a marketing standpoint?
Well, that's a great question.
Just getting those online and, not necessarily getting with the experienced mortgage pro, on your team.
Where's Jared? He's my social media guy now. We do a lot of social media. Obviously, a lot of the programs we have are directed to first-time home buyers, especially when it comes to the bond programs and down payment assistance programs. I think that we have really good underwriting standards. I've actually had conversations with my underwriters about the length of time and how many job changes somebody has, and they're all on board. They agree with me 100%. But how to reach those people? I mean, that's the real question out here, right? I don't have a 100% right answer.
Insurance too,
Yeah, for all of us, right? Right. It's real estate, mortgage, insurance. How do you get to them? I think you've got to be present. You've got to be in the places that they're at, which is not on Facebook, by the way. My kids are not on Facebook. I think Facebook's for old people, Dad. I'm like, you're 22 years old. And so they're on Instagram, they're on Snapchat, they're on these other things. YouTube's the second biggest search engine in the world. Everybody uses YouTube. I use it for fixing stuff, cooking stuff, making stuff. I mean, for everything, right? You got to be on there. You got to have but you have to have a good presence on there, not just a half-assed presence on there, too, right? Because people see right through that. I think there's opportunity out there. I don't know the exact answer. We're trying a myriad of different things to try to get in front of people, right? But you've got to do it the right way. You've got to be professional about it, right? Because people see when you do it halfway, they can just see right through it. Bad videos that last for 5 minutes, right? Those are worthless. So in conclusion, I'm just going to say, I know I've given you guys a lot of information. Is there going to be a recession? Is there housing affordability? What are rates going to do? All of these things are just opportunities you want to think about for the future, right? So I have one little story I'm going to tell you. So a psychiatrist, he has twin boys, right? Comes to Christmas time, he goes, you know what, I'm going to do an experiment on my kids, 2 twin boys. One's a pessimist and one's an optimist. So in the Christmas Eve, he goes into the pessimist room and puts every cool new toy you could think of there, iPads, Xboxes, everything. In the optimist room, he takes some horse dung and he spreads it all over the room. Waits till the next morning. The next morning he wakes up, goes into the pessimist room, and he goes, wow, son, look at all these cool gifts you got. And he goes, well, I've got to get batteries from them. They're probably going to break. I've got to read all the manuals for everything. I don't know when I'm going to have time to do that. Okay. He walks into the kid with the horse dung all over the room, and the kid's running around looking for things, going, oh my God, this is so great, this is so great. The guy's like, what are you looking for? The pony. That's an optimist, right? So you got to find your pony in all this stuff, right? All this crap we just went over. But any other questions, guys? Thanks for coming today. I appreciate it.
Thank you.